Every 3 months, the SEC requires investment managers with over $100 million in assets to reveal exactly what's in their portfolios. It's known as a 13F filing. For everyday investors, these documents offer a rare window into the current holdings of the world's most successful billionaires, often used as a direct source for new investment ideas. But the latest filings show the supposed smart money is in total disagreement. Take Amazon. Seth Klarman just bumped his stake by 20%, making it his top holding. At the same time, Bill Ackman slashed his position by 25%. Blindly following these trades can lead to a portfolio of conflicting bets. There is no single smart money consensus on where the market is heading. These managers are optimizing for entirely different goals, timelines, and risk tolerances, meaning they are often playing different games on the same field. To find the utility in this data, we have to look past the ticker symbols and analyze the three distinct strategies these super investors are deploying this quarter. Reverse engineering the logic behind these trades reveals the specific frameworks you can apply to your own risk profile. The first strategy involved a massive push into AI infrastructure fortresses. Warren Buffett and Seth Klarman are aggressively consolidating capital into the mega-cap tech hyperscalers that underpin the entire digital economy. Consider the underlying math. If a company's stock price stays flat while its earnings skyrocket, the price-to-earnings ratio drops. This is multiple compression. Because earnings for these giants have surged so much faster than their share prices, they have become mathematically cheaper than they were 3 months ago. Buying these companies requires accepting their massive spending habits. They are pouring tens of billions every quarter into a hardware arms race, buying chips, building data centers, and scaling AI infrastructure. Look at Google's balance sheet. They generated $244 billion in earnings over the last 12 months. But once you subtract that heavy infrastructure spend, the remaining free cash flow sits at only $53 billion. Amazon follows the same pattern. Cloud growth in AWS accelerated to 37%. But to fund that expansion, Amazon is aggressively tapping debt markets and pushing their free cash flow into negative territory. This strategy requires the investor to tolerate constrained or negative cash flow for several years while the company builds its moat. You are betting entirely on management's ability to turn this massive capital expenditure into a dominant, unshakable position in the future AI landscape. Bill Ackman is leading a different rotation, moving capital away from speculative tech and into wide moat businesses we call toll booth monopolies. His new positions in Visa, MasterCard, and S&P Global represent the gatekeepers of global commerce and credit. These businesses are remarkably efficient. Since their global networks are already established, they command profit margins between 40 and 50% and require very little capital to maintain their dominance. The trade-off is the valuation. These companies are rarely cheap by traditional standards, meaning you must pay a premium multiple to own these predictable cash flows. These monopolies generate recession-resistant cash today, providing a level of safety that the cash-burning AI race simply cannot match. Choosing this path means prioritizing margin safety and long-term predictability over the high-velocity growth potential of big tech. The final strategy is the most aggressive, hunting for extreme deep value in international markets that most Western investors avoid. Monish Pabrai is deploying this strategy in Kazakhstan with a heavy stake in Kaspi, an all-in-one super app that dominates the country's banking and retail sectors. On paper, the metrics are staggering. Kaspi produces billions in cash flow, maintains a 10% dividend yield, and trades at a PE ratio under 9. However, management volatility is high. When the CEO pivoted to expand into Turkey, the dividend was temporarily suspended to fund the move, causing the stock to collapse before a later recovery. Li Lu is chasing similar value in China with PDD, the parent of Temu. The company sits on $64 billion in cash, nearly half its market cap, while trading at a steep discount to its growth. This strategy requires an appetite for geopolitical risk, regulatory shifts, and the threat of international delistings that could wipe out gains overnight. These moonshots offer mathematically superior potential returns, provided the investor has the iron stomach to weather violent price swings. Returning to the divide on Amazon, Ackman and Klarman are both making logical moves based on their specific goals. One is prioritizing cash preservation, the other is prioritizing future growth. To find your own strategy, look at this chart mapping valuation against execution risk and determine where your personal psychology aligns. Investors who want hypergrowth and can tolerate heavy spending should focus on AI fortresses like Google and Amazon. Those requiring absolute margin safety should look toward toll booth monopolies like Visa and MasterCard. Only those demanding a massive margin of safety and stomaching geopolitical volatility should consider deep value moonshots. Use 13F filings as a sophisticated ideas generator to build a watchlist that matches your specific temperament. Durable, long-term returns rely on the individual investor's ability to maintain absolute conviction in a specific financial strategy, rather than the temporary momentum of a copied ticker symbol.